Hello, welcome to our discussions on accounting. From today we are starting a series where we would like to observe accounting for the business on the street. When you walk on the street, you see business everywhere. And these people on the street do business in supplying food, providing services from scooter repairing to hairdressers to fashion design. So when you closely observe these businesses, you can also see the business dynamics. You can see the interesting innovations that these people do in their business. The focus of our series is to observe accounting and financial issues. We call them our boss. In this session, I would like to share with you the experiment of a particular vendor who has strengthened the balance sheet over a period of time. When we first met him, we saw he had no balance sheet at all. He's a small business supplying or dealing with the groceries near a large business school operating in one of the states of a country, and that is the Xavier Institute of Management, Bhubaneswar. So when we met him and asked him whether he has any books of records, he said he has no time to keep records, and he also said that he don't see any benefits of maintaining those sets of books. But over a period of time, when we started interacting and explained to him the benefits of maintaining records, and one of such benefits is availing loan, that motivated him, and we started giving some basic training, and with the help of our students, after getting the loan, we prepared the first balance sheet, and the first balance sheet looked like this. The balance sheet of this person, it has a stock, a bike, furniture and equipments, and cash. It was easy for us to understand and identify the assets, and then we saw that there was a loan which has been given to him by the banker whom we introduced. So the balance was treated as equity. The balance was treated as equity. So equity is equal to assets minus the liabilities. So he used that assets, he used the loan to buy certain equipments, which was actually the construction of a room, and also used that small loan to purchase stock. But this was not at the time of taking the loan, but at the end of the year. Then slowly as the time passed, he took the benefit of the checkbook, which he started using to give it to his suppliers. So with that particular intervention, or the change in a practice from a cash payment to a check payment to his supplier, he could see some changes in the balance sheet and his business. So at the in the middle of 2012, that means most probably in the month of March 2012, when we met him and once again prepared the balance sheet, we saw the balance sheet has taken a new shape. What is that change, and how did he do that? Number one, the debt is no more there. There is a creditor of 22,000. The creditor, because he started giving them checks, giving checks to the supplier, and the supplier deposits the checks, at the end of the week, at the end of a week. So for 7 days he started enjoying the benefit of the credit. And what did he do with that extra stock? He purchased the stock on credit and started selling it. Is still now not maintaining his income statement, so we are not able to show the income statement even now, but we are trying to understand his business through the balance sheet only. So the long-term debt becomes zero. That means he has generated enough cash to pay back the loan. He made profits because his equity has increased, and he has used the credit to purchase the stocks. The stock increased. No further increase in the capital expenditure, and is still having a cash of 10,000 rupees, which we have to tell them the use of. What is the use of maintaining the free idle cash? He could have converted that into stock. So what did he do? In the first days he had no balance sheet, no understanding about the financial statement. As a result, did not feel the importance and relevance of the financial statement. But with some amount of training and awareness, when he started taking the negotiations with the bank, he started feeling the importance of the financial statements and recording. When he took the loan, he had to prepare the balance sheet, and the end of that year he got this balance sheet. Then he availed the check benefit because the banker was happy with the balance sheet. So the banker gave him the check facility. The check was used to pay money to give it to the supplier, and the supplier used to deposit it on the end of the week. So in the process, he paid off long-term loans by using this supplier's credit. He shifted interest-bearing liabilities, reduced the interest-bearing liabilities to non-interest-bearing liabilities. I call this person as the financial innovator, or a financial reengineer at the bottom of the pyramid. From no balance sheet, relatively good balance sheet, to a strong balance sheet. So Rabindra emerged as a financial engineer at the bottom of the pyramid. Thank you very much.